But now we have an exciting panel ahead of us with, like I said, accomplished VCs sharing experiences about how to raise capital, about how to deal with foreign investors, which is, like I said, like the second coming, I guess, for the startups of today. I think they simply do not realize how lucky they are. So the first such panel or discussion, you name it, is going to happen between Guillaume Fournier and Henri Tilloy. Thank you for, yeah. I practiced a lot of the French names, so I'm very proud. From Credo Ventures, Prague, and Partech Ventures from Paris. So, guys, you have any interesting thoughts to share? Please share us about the risks of raising capital from abroad, how to do that, what are the chances, what to look for, any tips and tricks, best practices, shortcuts, like, I don't know, attacking you right after this event and not letting you go until you give us money, or, you know, you name it. Yeah, blackmail is always a good option, I guess, no? Okay, so, guys, it's your turn. And just kill it.
All right. Hello, everybody. I think, so the conversation we're here to talk about is how to raise a Series A, Series B round when you're a Central and Eastern European startup, or most likely a Hungarian startup. I think before we jump into it, there's a couple of slides just to give you a quick intro about who Henri is and who I am myself.
Yeah, and this is slightly in the context, I mean, we crafted this in the context of enterprise SaaS, but I mean, many things are also true if you're a traditional SaaS company or if you're building a marketplace, but a few things are more specific for enterprise SaaS companies. So just very quickly on Partech, this is just a very brief snapshot of our portfolio, just to show you what kind of firm we are. So we invest all across Europe, the US, Southeast Asia as well. The firm started about slightly more than 30 years ago in San Francisco, so we have offices in SF, Paris, Berlin, and we invest across many stages. Myself, I focus on Series A and B in Europe and cover countries like Hungary especially. So this is why, for instance, I put those two logos that you might know on this particular slide, one in the middle, which is Bitrise, and the other one below, which is Consigna, which are two companies founded and headquartered right now in Hungary that we're very proud of. So also to show you how real that is, meaning that we invest in the UK, in France, in Germany, but also very actively in a country like Hungary.
And then myself, Guillaume, I'm the French guy on the Credo team. So Credo Ventures, for those who don't know, we're based in Prague, but I wouldn't call us an international investor because we focus on seed and Series A investments in the CEE region. So we spend a lot of our time in Hungary. We've made a number of investments here, but also Poland, obviously Czech, Slovak, Romania, you name it. So seed and Series A, which basically means our job is to basically be the first, often the first institutional investor, and then put the startups in front of guys like Partech. And that's why you might see on the slide that Consigna is in there as well, because we invested in Consigna a couple of years back, and now they just raised from Partech, among others. So Series A enterprise SaaS, although I think this slide includes basically quite a few of the Series A of the region. What the topic of the conversation that we're going to jump in is really what does it take for CE to raise Series A? And as some of you might think, can CE originated startup raise Series A, go international and raise? And I think this slide is meant to be to go over quite quickly, but it can show you that yes, there's quite a number of success stories now that the CE region can be proud of and show as examples of companies that have completely have their roots in the region and have moved on to raise quite significant rounds from Partech or from other investors when we look at some of the companies on this slide. Some of them are Credo's portfolio, we're proud to say. Some of them are portfolios of the other VCs that are here today. And we'll use a couple of them, I think, later on to give you the story of what happened basically when they raised the Series A. More particularly, I'll speak about UiPath and Price Effects because I think they're pure play enterprise SaaS companies. And if you're familiar with UiPath, I think a lot of people are often eager to hear about it, given how much of a success it's been. And Henri obviously will talk about Bitrise since it's a recent Hungarian local great success. Comsigna, we just co-invested, well, Credo invested in a couple of years ago, and now it went on to just raise another round, but it was just announced, I think, and we can talk about it a bit briefly, but don't want to share too many details because it's a bit fresh.
So, I mean, we're going to cover a lot of the things across different slides, but I guess one question we're often asked is, how to trigger an A and B, and this is, I would say this is in general, so not necessarily specific to the region, Hungary or CEE, but like those are like big criteria, especially for enterprise software, because this is questions we have very often. If you sell to very large corporates, you cannot show traction in a way someone that would sell to consumers or SMBs can show traction. You're going to have 1 or 2 POCs, 1 or 2 very large contracts maximum, right? Because you're negotiating large deals with long sales cycles. So what can you show at Series A stage, and what should you show at Series B stage, basically? So the way we think about it, and obviously it's very subjective, there are many ways to think about it, is at A stage, you're not really supposed to prove on pure metrics. The number one thing we want you to have is basically the second line when we say clear customer target and go-to-market strategy is a product market fit. So you have a product, people want to buy it, it makes sense, and this captures a very large market opportunity. You've figured something out that others haven't, and you're ready to raise capital. In terms of traction, since it's enterprise software, at A stage, usually you're a company that has, that has been launched, 1 year and a half, 2 years ago, something like this, on average. So we don't expect you, to be able to prove like some sort of ramp up in pure ARR. You probably have like 1 or 2 flagship customers. The rest are still trying out the product. You're still trying to figure out your sales process. So just try to understand that those core corporates need that, and then that you only need to raise capital to like figure out how to scale that thing. And so other more, I'd say, standard things that we want to mention is, so first of all, massive market opportunity, and I say here, bottom up. We'll talk about this later if we have some time, but like bottom up meaning like how much every single one of your customer can pay you for that particular product times the number of customers you can potentially have. Never give like an industry figure, like for instance, AI is a 3 trillion business, whatever, worldwide, because it's not really your market. Like if you're selling, for instance, a TMS, like a tracking system for logistics to corporates, typically, say that a retailer would pay, I don't know, 300K for that. Very large retailer at the scale of a country. Okay, fair enough. How many of them? And boom. It's a very simple calculation. Just to give an idea, and obviously you wanted to mention as well the standard equity story, meaning that, and we're going to get to this later. I'm sure you have tons of things to say because you have more experience with me in this particular region. But what we mean by standard equity story is that you haven't raised crazy amounts of capital so that your cap table would look weird. You're looking for a reasonable amount for a Series A. We can talk about this if it's one of your questions, like how much should I raise, and that you're not too diluted. You haven't given up, too much of your equity, for instance, to a business angel, which sometimes happen. We want the founders to be significantly incentivized. So if everything looks healthy and you have this, you're a good candidate for a Series A in the context of enterprise software. And then the B round here is slightly different. It's like you've raised your first big round with an A, and you've started putting in place the different blocks to have your sales playbook. And so now you are a machine ready to go out there and sell for real. So at B stage, traction and actual KPIs that we're going to look at do matter. We start looking at this earlier if you are a traditional SaaS company. For enterprise software, my guess for me is typically at B round, which is when I guess Excel entered on UiPath, probably. Meaning here you cannot really cheat on figures. It has to be, you have to prove that there's an inflection point. And I guess the number one thing as well is that your ability to beef up an international team, and especially usually regarding sales. We'll talk about this again with the example, the Hungarian example of Bitrise. Bitrise is 100% a Hungarian company, founded in Budapest. All engineers are in Budapest. They're amazingly talented, and they had and they still have this challenge to hire very talented people in San Francisco, in London, that can sell to Oracle, to Sinsit, to Uber, to companies like this. And so you need to have these building blocks, like how do I hire a VP of sales in the US? How do I hire a VP of sales for Europe? How do I interest these people, et cetera, et cetera. So this is the kind of stuff that you should start putting in place when you're, to see if you're mature or not for Series B. And then other stuff, obviously, part of the due diligence, they're going to assess customer pipeline. You still have to have a big market opportunity and a standard equity story. I don't know if there will be any question on this, but just wanted to make sure, once again, in the context of enterprise software, since a lot of founders are confused with metrics, what should they do, what should they not do, because their ARR looks a little weird, because it's one-off engineering costs, for a lot of their customers. Should they go raise money now, not now? So this is kind of the framework we have. Okay. And so once again here, it's just a quick highlights on market size, because once again, what we really value is a bottom-up approach and no industry figures, no traditional market figures. We need, to understand that you actually very much understand your product and market. Like how much money can you get from your customers? That amazing software that you've built, if you sell it to super large corporates, like you sell it to IBM, what does it mean for IBM to be a customer of yours? How much would they pay? And here, you will quickly realize that when you target enterprises, there are not that many of them, right? You have like Fortune 500, Fortune 100, but you're not going to have billions of them. Especially, if you look, the way usually you would approach your market is going to be, first Hungary, then the rest of Europe, the US, et cetera, et cetera. So one way we look at this is like, for instance, if your product is what we would call a vertical agnostic, and I think here Bitrise is a good example. Meaning that Bitrise sells a product basically for engineers and developers in the context of mobile. And every single corporate out there needs to have a mobile app, whether it's Uber or Tinder that you might be using on your phone for consumer apps, or a corporate app that you have for internal events, et cetera, et cetera. Whether you are a big retailer, a business selling software, or some business, I don't know, a fintech or a bank, you're going to need that. So this is vertical agnostic. So here, for your market size, you can afford to have, let's say, smallish, and I say, I quote on this because this is also already fairly big. On the other hand, if you are vertical specific, like once again, a company of ours in France sells a logistic tracker that mostly interests companies in the retail space, you have to charge them big time. It has to be very, very significant ACVs because you have fewer candidates. So kind of a scenario where you have, usually you can have like a first-hand product that you would sell, very quickly with inside sales, inbound, et cetera, and then a dedicated sales team for your super large contracts.
And I'll jump in with one more factor I think that's important to consider in there is how long and how much resources and effort your sales cycle require in context of those ACVs. So this is for market size, and obviously if there's few enterprises out there that can be your customers, then they need those ACVs. But obviously it's also okay to have smaller ACVs as long as the sales cycles are low effort. They can be long, but that's okay as long as they're low touch, like a couple of emails, because we understand that enterprises can be slow and cumbersome, and sometimes the ball is in their camp to just get through procurement. But that has, I don't think there's a specific metric, but you have to consider how long the sales cycle takes. So I believe after this is the last slide on the theory, and after that we go with the stories, we promise. Some of this stuff we mentioned already, but other miscellaneous topic that are going to come up before you raise your Series A is whether your cap table is healthy, whether the founding team is still a strong majority of the company, and this has to be taken into the context of VC math, and you have to understand that Your investors are going to look to take 10 to 15, even maybe up to 20% of your company, and your next investors as well. So you need to accommodate for that dilution, because otherwise their economics don't work. But at the same time, they want to make sure the founding team is fully in control, fully incentivized, because they realize that if one day they wake up and get fed up with this and leave, then the company is worthless. So that's what we mean by healthy cap tables. How much has the company raised before is less of a factor, but it's taken into account, meaning that if it took you tons of, a couple of millions through several seeds and bridges and post-seeds and pre-A fundraisers to get to your 1 million ARR or wherever it is, wherever you are at the time of raising Series A, it's a bit less impressive than if you've bootstrapped your way there, and your potential investors will have some questions about what the hell happened there, and there are answers to this, like you tried something, it didn't work, you had to pivot, and you wasted some time and money. That happens, and that can be understandable. The last factor, which is also a bit more intangible, is around the team. I think Series A and definitely at Series B is when a company transforms, a startup transforms from being a startup to being a company, and starting to have processes, hiring processes and reporting lines and hierarchies and that sort of thing. And also start to attract senior executives that are going to come in that are not part of the initial bootstrap story of we all know each other and we're all in this together. They're senior executives that are professionals and have worked in many other companies before that can make a massive impact on your company. And I'll say it's a bit unfair to expect that you would attract these people pre-Series A, but it's always a good sign if you can start having them in your pipe or establishing those relationships so that you can come to your potential investors and show to them, look, we're raising a Series A of 3 million and we have these guys lined up, they're willing to join, it's just that they're kind of expensive because they're very experienced, but they'll jump on board. And definitely at the Series B stage, that needs to happen between the A and B. I think you wouldn't invest in a B at the B stage without a sign that they can attract top talent.
Yeah, clearly. Because it takes a while. Like for instance, ramping up, and we can also take I mean, we'll talk about this later, the example of Bitrise, like for instance, in any other company, ramping up a sales team takes a super long time. Hiring your VP of sales is going to take, I don't know, you're going to go for a headhunter, it's going to take a few months, you're going to interview a few people, the person is going to start, you know, it takes 2-3 months to get onboarded. That person, if it's a good VP of sales, is going to bring its own people, and so hire a bunch of other account executives, et cetera, et cetera. And so the whole process takes about 2 quarters, honestly, but before you're up and running and you can actually do this. So as soon as you start doing it, I'd say post-Series A, because it's hard to do. I mean, salespeople are so attracted by money, so before you raise a round, it's always you know, harder to attract them. But yeah, it's a good way to start thinking about it. And another factor that is not mentioned here, because you know, for the sake of this presentation, we're slightly biased towards enterprise software. But one thing that is very different here, we mentioned traction is not necessarily a key KPI. But like anything else beside enterprise software here, another key factor is obviously traction. Like if you manage to scale super quickly, I mean, I guess it's the number one way you can attract very good investors. Then, okay, so I mean, quick highlight on Bitrise. So I just put a very brief timeline here. I have one slide, but tons of things we could talk about if you have potential questions. But just to give you an idea, because I think it's a very good example for a company, once again, that was pretty much born and raised in Hungary with Hungarian founders. So they basically were lucky enough to go to Y Combinator early on. A few months after this, so you see the timeline is only a few months, but that means it was announced at that time. They basically started fundraising right after Y Combinator, raised a Series A, and then they executed tremendously for a year and a half. We ran into them at Partech, fell in love, and decided to invest. So that's kind of like just to give you the timeline. Then, and if you have particular questions on this, let me know, because there's, once again, tons of things to be said about Bitrise. What we liked about it in the first place, and what we realized early on, is that although it was a Hungarian company, we quickly realized after we had met with Barnabas, Daniel, and Victor, the 3 founders, that it was an international firm. No question. When you go to their office, it looks like a Silicon Valley company. Everybody speaks English. They have a Delaware corp because they went to YC, but it's not required. I mean, it's not something that you have to have, but you mean that there is this startup DNA and culture. It feels like, it really feels like a startup that is ready to raise money and actually go for the long run, right? So that's the number one thing, I guess, is the ambition you can actually feel. And we have the same, to be very transparent, we have the same problem sometime in France with founders that are like super French, thinking about their own market, because France is a slightly bigger market than Hungary, but it's not humongous, and so you start being comfortable in your own market, etc., which might be a problem in the long run, and which it definitely is when you raise a Series B. So that was, I guess, the number one criteria. Very impressed by this. Then obviously the team and ability to execute. So here I mentioned, I think it was a 5x growth. For them, the way they track stuff is pure ARR/ARR, but they're selling a very technical product. Once again, so it's CI/CD if there are some nerds in the room, for mobile developers. So it's not your traditional CRM, and the way they executed, put people in place, hired a VP of marketing that was a completely different background, had the guy move to Hungary and Budapest, etc., put stuff in place in San Francisco, started hiring a VP of sales, look around, taking advice all over the place on like, how can we scale that particular aspect, that particular product? Should we think in terms of, when we have customer success and sales, how should we interest them, right? When we look at, for instance, our quotas for salespeople, should we include renewal for salespeople, or should we include that for customer success? Those are like super small, tiny questions, right? But they're actually crucial. And if you start asking yourself those questions at this stage, it's a very, very good sign, because then it means that you're ready to scale, provided that, once again, there's room to scale, which means a very large market opportunity. So I don't know if there will be any specific question on Bitrise, but since I thought it would be very interesting to talk about them, because it's a very local example, and we just invested and are very, very excited about this one. But like, if there's anything you guys would want to mention or ask about, we're more than happy to cover that.
So another example to try to illustrate what it takes to raise a Series A and then a Series B when you're a company from the region is UiPath, Credo's basically biggest success. So UiPath, for those who don't know, is a company from Romania, and they are in the robot process automation space, which I don't know who came up with that name, because there's no robots involved, or at least no physical ones. It's software. It's basically horribly unglamorous software automation of back-end processes for corporates. And it turns out that it's a massive market that is growing really rapidly. But to try and illustrate what we covered in the previous slides on theory, just wanted to mention a few things about UiPath. At the time of them raising the Series A, which was at the beginning of 2017, and then at the time of Series B, which was in the beginning of 2018. The most obvious thing is they were growing like crazy. They were growing 5.7x, I believe, year on year. And these are annual recurring revenues, which, by the way, I don't think we mentioned or briefly, is the golden KPI for enterprise SaaS companies. It means, I think the name is a bit counterintuitive, because you would think these contracts of subscription with corporates imply that they can cancel them at any time, and that's kind of true. But it's what the investors like, because the truth is, recurring means that that unless something really fucks up and the company does the product becomes bad or broken, these revenues are just going to keep coming every month or every year, depending on the contract terms, without you having to do much. You might need to do a bit of service maintenance, a bit of renewal work, but for the most part, you've done the selling and now you can just cash in, and that's basically the definition of scalable revenue. So that's why this concept of annual recurring revenue is your goalpost. And obviously, if you're growing 5.7 times year on year, needless to say, you'll have an easy time raising your Series A, and if that keeps going, you'll have an easy time raising your Series B. A few things that are not on this slide about UiPath. are also the stories behind the expansion of that ARR within each account. And I think that was true for Bitrise as well, whereby going back to those ACVs, to those average contract values in relation to your sales cycles, the one way you can justify a small initial ACV and a long sales cycle, to some extent, is if you can then show that within your customers, those contracts grow and expand inside the companies, which is what we call expansion ARR. The flip side of this is churn, obviously, and needless to say, if you have a lot of churn that compensate any additional or expansion ARR you put on, you will have issues. Other stories of UiPath, by the way, is that often the investment thesis are built around team, but when it came to UiPath, at least in the early stages, the team was obviously very solid as an engineering team, but the initial view was that the founder, who's still the CEO to this day, which is why it's okay to share this now, did not want to stay on as CEO initially. He was pure engineering, did not see himself go past Series A to become a manager of a company that has now thousands of employees. Turns out he learned, so he stayed on. But this is a case of compensating, like the numbers kind of erased everything else. But so to which button?
Yeah, but maybe, I mean, a quick comment on this chart. UiPath is an incredible story. I mean, it's probably, to my knowledge, the most successful enterprise SaaS company ever in Europe. So I mean, just also for the sake of saying it, if you don't have an 8x multiple year on year on your ARR, just like UiPath, doesn't mean that you're not going to be able to raise a Series A or B. It's the most insane traction I have ever seen. So. Yeah, and just so one thing, because you give me you remind me of capital efficiency, so another opportunity to talk about Bitrise. One thing that was very interesting for us as well is that, so at that time when we invested, it was slightly different than the case we talked about for typical Series B, because they managed to get to that growth and that level, 5x, only with inbound, doing absolutely no marketing, no salesperson whatsoever. Which was truly, truly impressive. So since it's a developer tool, they had some sort of like very small marketing budget to make it viral, make sure that one developer would recommend the product to another, et cetera, et cetera. And we could see this effect where, insanely capital efficient. They had not even spent their money from their Series A when we run into them. And so the beauty of that model, that we're just able to attract a lot of people from a lot of corporates and get a foot in the door, was super interesting. And to be very transparent with you as well, there's a very famous example of a company that has done tremendously, which is Atlassian. They are considered now an enterprise SaaS company. When you buy...
They never raised, right?
I don't...
the story of Atlassian?
Yeah, there's a story like they never raised, or maybe just one small round. So yeah, it's very, very beautiful story. And the reason for that is that now they're considered, an enterprise SaaS company, because, if you buy Jira, Confluence, etc., at a tech company, it probably costs you tons of money. But the way they did it is 100% bottom up. So you would have one developer logging in and say, I just want, my code and flow process to go through this thing, and then invite another dev at another team, etc., etc. And this started growing inside every single corporate, just like this. And overnight, you would be, once again, a company like Coca-Cola and just realize, wow, I pay 200K to this small vendor. I have no idea across all my multiple business unit. Let's make it a corporate agreement. And they had this strategy going bottom up with a viral strategy from developers. And you can leverage that differently. But that's something that attracted us a lot into Bitrise, because they had this similar thinking into we're going after developers first, and now that we're in, this is the number one thing we're working on, is transforming all those individual people that are using Bitrise at many organizations realize that they can actually benefit from a much larger contract. But this is a super efficient model, and it can also work for enterprise sales. If you have a product that has a lot of usage, people are supposed to use many times, very often, then it works. If you are, for instance, a tool doing BI and only the very top executives are going to use you, then it's not really a tool that can spread out across the organization. But something usually like developer tools are the best candidate for that.
So last story is the price effect story, which I think is a bit more rational as a Series A. As you can see, Credo invested in 2016, late 2016. The growth rates are a bit more normal, let's say, not even growing 2x year on year. A good chunk of that revenue was not recurring. It was from one-off maintenance and services contract. So here you might ask, like, why would we invest? Because no beautiful 5x year on year, not such high ARR. But behind, again, those numbers and part of the overall picture was a story of momentum. Momentum around the numbers. I mean, the growth is not that bad. Momentum around the effort inside the company to grow the recurring part of the revenue instead of the services. The momentum of closing more and more contracts, big contracts with big enterprises every year. And also, in this case, the team was a full-on part of the thesis because basically the Price Effects team, at least the 3 founders were I don't know how old they are, and I don't want to insult them by guessing. But anyway, they were senior executives who had worked in the pricing industry, had learned everything there was to learn about the pricing industry, working at old incumbent non-cloud companies, and realized, wait a minute, there's a huge opportunity here. Let's leave, set up our own company. And so when you have that in addition to the numbers, it balances out, and you don't need the UIPath numbers to raise a successful Series A.
One thing as well, I think Price Effects is a good opportunity to talk about this, is that since you're selling to enterprises, because Price Effects is very, very, very large contracts, to my knowledge. So very large contracts, meaning that you have to bring them a lot of value. And a software like Price Effects typically integrates with your sales team, your product teams, your executives, like literally everything. So you're insanely sticky. For instance, I remember in the pricing industry, there were examples of like automotive company, that sell cars that were trying to shift from selling cars to selling cars on subscription. Sounds like a reasonable idea, etc. They want to explore this. But for a company of their magnitude, it's insane. They have to reshuffle literally everything internally. And so if they do this using a software like Price Effects, then you win. Because that means you have this customer for the next 15 years with an ACV that is, sky's the limit.
And yeah, there is something I didn't mention, that despite all these integrations needed with your ERP, your CRM, all your internal processes, Price Effects was also able to show some very short in the enterprise sense of the word. So like, let's say, I think it was about 6 month sales cycles to those ACVs that were in the 6-figure ballpark. And fun story is Partech looked at Price Effects for the Series B for a long time and passed.
Yeah.
And I bet they regret it now.
That's why I know about them.
Yeah. Exactly.
Then I will have just a quick question. That when you said healthy cap table, can you just pair numbers, percentage to that as well? So before Series A round, let's say.
So I never like anchoring anything in concrete, because then you're thrown an exception in your face, which there's plenty of. But
are you happy if they gave up for the angel round and seed round 60%?
So I would say every round should be in the 10 to 25% dilution range. So if you raise your seed, try and stay at the maximum 20% dilution, then at the A again. And the more mature you become, B, and later on, the less important it becomes. Because at that point, it's okay to, like, I don't know how much the founder of Uber still owned at the time of the IPO, but it was pretty marginal. Facebook is a completely different story, where it was so hot that it basically took very little dilution. But yeah, 10 to 20%, maybe up to 25 per round seems healthy.
Yeah, I agree with that 100%. So the best scenario, ideally, let's say, I mean, the best scenario is that you don't have to raise money, obviously. Yeah, exactly. But the second best scenario, let's say, is that you raise the seed money, and so there's still, 80% of the company, around 80% of the company that belongs to founders, and then you go for a Series A.
Thank you very much, guys. I think it's kind of untold stories what you shared now about PriceFX, Bitrise, and of course UIPath. So thank you for the details, and please stay for the networking because the audience may have other questions. So thank you very much. Warm applause.